Buy land, they're not making it anymore. The words of American writer Mark Twain. Even if he did not specialize in investing and financial matters, he summed up the entire road to financial freedom in that single line. History has proven that real estate makes people rise in society, often to become the elite. We saw this during the Middle Ages when feudalism created feudal lords. Even today, real estate is a hallmark of financial status. Andrew Carnegie, one of the wealthiest entrepreneurs of all time, said that 90% of millionaires become so by investing in real estate. But how does this really work? Let's find out. Hi, I'm Manyara Kirago and I have been a personal financial professional for the last 2 decades. In this video, I explain the pattern I have noticed during my career where real estate investing ultimately led people to financial freedom. This video is for anyone who wants to achieve financial independence but does not know how to get there step by step. Watch the video until the very end to learn practical steps to achieve financial freedom by investing in real estate. If you need help to ensure you get the best outcome with your finances, I am available for your support. Please check out my do-it-yourself online video course and my one-on-one financial freedom coaching, and also Eternity Real Estate Program from the links in the description below. If you like this kind of content, please subscribe and share with anybody who you think may benefit from it. Also, ring the bell icon to be notified each time I post a new video. So let's get started. Financial freedom means living your life however you want, without worrying about money. For many, this looks like an impossibility and looks unreal. But for those who know about real estate and its power, it's just a matter of strategy and time. And now you're going to know about how it works. But let's first get to know why real estate is the ultimate key to financial freedom. Number 1, the inevitable high demand. By investing in real estate, you own something that is in high demand, whose value increases daily. It is a law in economics. When supply of something decreases or is limited, its price increases. Nobody can create more land, making it a limited resource which everybody will compete for. Sometimes there can be period of demand dips, but that's when you should buy property. But in the long term, population growth is inevitable, creating more demand for your property. If there was one renter earlier, then with time, the numbers will increase, increasing the income of your property. You can monetize this and make profits. Number 2, diversification. Investing in property offers a valuable way to diversify your portfolio. Even if you already invested in stocks and other investments, adding property helps mitigate risks. This is because real estate is a tangible asset whose value lies in the benefit it offers, unlike stocks, which are intangible. If the stock market crashes, you'll be left with worthless stocks. Ask anyone who owns shares of Uchumi supermarkets. If the real estate market crashes, your property won't vanish. Its value will temporarily decline and then rebound. During this time, you will still have the property. Number 3, rental potential. Property ownership provides an avenue for generating a consistent passive income through rentals. By owning units and properties that bring more rental income than your personal expenses, you generate a surplus. You can then use this surplus money to buy more properties, increasing the rental income further and beyond to complete financial freedom. Number 4, the property pays you 3 times. If you know how to use the property at its full potential, it offers you money 3 times. First, the property pays you when you buy it at a bargain. In other words, you must ensure you buy property below its market value, giving you an immediate financial gain. Secondly, your property pays you when you rent it out, allowing you to collect monthly rental payments, effectively transforming your investment into a cash-generating asset. Rental income can complement your primary earnings, offset mortgage expenses, and improve your overall financial stability. The third time your property pays you is when you sell it. It's when the stored value, which has appreciated over time, is unlocked. Historically, real estate has exhibited an appreciation in value over time, surpassing other asset classes. Number 5, leverage. Real estate allows you to use other people's money as leverage to make money. In other words, if you don't have enough to buy a property, you can use a mortgage, which in essence is like using other people's money deposited in the banks. After buying the property, you can rent it out and cover your mortgage payments using the rental income. But for that, you have to strike a delicate balance between the cost at which you buy the property and the rent you make. It is necessary that the property be bought in a location where prices are low but the rent is high. Only then can the mortgage payment be covered using only the rental income. There are many people who are adverse to debt and consider it risky. However, you should know that debt can be good or bad. If you take out a loan to buy a depreciating asset like a car, that takes money out of your pocket every month. It's a bad debt. However, the debt taken is good if you're taking a loan to buy an asset like a rental property that will bring money into your pocket monthly in rental income. Hence, you have two options. You can choose not to take a good debt and miss out on owning a property using rental income. Or you can actually take out a good debt and leverage on other people's money to own properties. Until now, I have told you why real estate is the best option for financial freedom. But now let's get to know how you will actually use real estate to achieve that financial freedom. One approach is called the Bur Method. It is a strategic 5-step process for constructing a real estate portfolio in which you buy, rehabilitate, rent, refinance, and then repeat the process. This systematic approach starts with the initial property purchase and ends cyclically, facilitating the continual expansion of your property holdings. Using the Bur Method, you unlock the capability to own multiple properties using the same pool of funds. You will know what I mean when I give you a practical example. This contrasts with traditional real estate investment, where securing fresh funds is frequently necessary for each property purchase. You see, the brilliance of the Bur Method lies in its self-sustaining cycle. Let's understand how this works. The process starts with an initial down payment to buy a property with a mortgage. Then the property is improved and rented out. The monthly rental income is used to pay the mortgage payment. After some time, when you have paid back enough, you refinance the property, which means you get a new loan on the same property. You then use the cash to buy a new property and repeat the process. In this way, you own property after property, each paying for itself. Let's try to understand that with an example. Let's say that you have found a property at a low price, potentially requiring minor repairs or facing challenges with the mortgage payments. Recognizing the opportunity to acquire an undervalued property, you negotiate the purchase price down from 40 million to say 35 million due to the property's condition and the owner's financial struggles. Now, you have two options. If you have cash, you can purchase the property outright. Alternatively, if you don't have immediate cash, you can secure a mortgage with a 20% down payment totaling 7 million shillings. This becomes your initial investment in the 35 million shilling property. Note that this 7 million shillings becomes a reusable fund for subsequent property acquisitions. Returning to the acquired property, you invest another 7 million in its renovations to make it look presentable. Subsequently, your total investment in the property amounts to 42 million shillings. Then, you find tenants willing to increase the rent to 375,000 shillings monthly, offering a consistent income stream. That's when you now refinance the property through a second lender. An appraiser evaluates the property's value, now elevated to 48 million shillings due to the renovations and the increased rental income. The lender agrees to refinance 75% of the appraised value, providing a new mortgage of 36 million shillings. With this, you can settle the initial mortgage of 28 million shillings, leaving you with 8 million shillings in cash. This amount can be used as down payment for the next property, mirroring the process of your initial purchase. In this way, you can continually acquire properties, leveraging the same funds while enjoying a consistent monthly income from your expanding real estate portfolio. You will ultimately reach a point where your properties will offer you more rental income than you pay in mortgages, making you financially independent. What do you think? Is there a better option than investing in real estate for financial freedom? How would you like to invest, and what are your other goals once you have achieved financial independence? Let me know your thoughts in the comment section below. If you want to learn in more detail how you too can generate passive income through real estate investing so that you can finally gain financial freedom, then what you need to do is to watch my free training. Click the button below in the description to gain immediate access to that training. If you loved this video, give it a like and subscribe to the channel for practical insights on financial freedom, personal finance, and financial literacy. Thanks for watching.